Well, Leslie, in the first 4 days of this COP, governments, businesses, investors, and philanthropies have pledged over $57 billion across the climate agenda. So joining me to talk about how all that money will be deployed is the Vice Chair of S&P Global Sustainable1, Richard Mattison. Thanks so much for joining us. Tell me first, you sit on a huge amount of financial intelligence. So are the capital markets really ramping up enough to finance the clean energy transition?
Yeah, so we have around 700 billion data points on climate change that we refresh every single year. And we actually monitor investment flows and investment requirements. And I just want to give you one specific example, which is actually quite exciting, which is when you look at the Inflation Reduction Act in the United States, we've been tracking private sector flows of money. This is not the disbursement of loans or tax credits. It's private sector capital market money. It's $100 billion in 10 months, in the first 10 months of that, after that act. So when you compare that with some of the pledges and some of the things that we've seen here, $100 billion mobilized in less than or around 10 months is remarkable. And we're seeing that across the world in various different ways.
Wow. So what is the level of opportunity for the Fortune 500 companies to take advantage not just of the clean energy transition, but climate adaptation and things like risk modeling and climate tech even?
Well, actually, risk is mispriced right now. That's the bad news. That's what we see. So when we look at risk, we would see that, for example, we've just released a study that would tell you that on the current trajectory that we're on, up to 4.4% of GDP on average across the world will be lost.
Really?
And if you bring that to today, the US government, in its 5th national assessment of climate impacts, has said that, that the scale of damages that the US economy is currently paying is about $1 billion every 3 weeks on average. So when you think about it, that impact and the cost of physical risk is actually significant and needs to be compared with the opportunity of transition. And quite often those two narratives don't stick well together.
So do we have enough risk modeling? It sounds like we don't if these companies are mispriced.
Yeah, so we've released another study that looks specifically at companies, and what we found is that for the S&P 1200 companies, on average, when you look at the actual assets that those companies own and where they're located and what kind of climate hazard is going to hit those assets, we found that on average about 3% up to 28% loss of asset value by those companies. And so what does that mean?
Yeah, what type of assets are we talking about specifically?
Infrastructure, bridges, power stations, mining plants, ports, all those kind of critical types of infrastructure. So the point is, on the current trajectory that we're on, we need to do something to adapt to that risk or lower the emissions trajectory. It's one of the two. And what we can say is that, roughly speaking, adaptation costs more than moving fast on climate change.
Okay, so we've talked about a lot of money coming in out of the COP, pledges to be made, but we've seen the U.S. government put a lot of money, whether it's the IRA or the infrastructure bill. How much has that government money really been a catalyst for private capital to go into climate?
Yeah, well, it has. The design of the Inflation Reduction Act was to crowd in private sector capital. Some say up to $3 trillion or even more from the $300 billion plus that has been committed. And that's something actually that we're seeing across the world. So if you look at the intent not just of the US government, but China, the Europeans, and also Japan. Japan has just launched something called its GX strategy. That's designed to crowd in $1 trillion worth before the end of this decade. So we're seeing vast mobilization of industrial plans, and in some cases that can actually be weaponized, because it means that it sort of could end up, in a bit of a trade conflict, onshoring of manufacturing. But where is that when you've got Japan, China, the EU and the US all doing the same thing? So
really risk upon risk. Great to hear. Richard Mattison of S&P Global, thank you so much for joining us, and we'll take it back to Carl.